The best trading happens at the no resistance area. I'm going to show you in a few simple steps how you can improve your trading using the no resistance area. Now, with all due respect, I personally could never really understand the way ICT explained a low resistance liquidity run. To me, it was always a little bit vague, but maybe that's just my own lack of IQ. So what I did, I dissected the word myself and I went into the charts to study it myself. That's how I got to the discovery of the no resistance area. So let's retrace those steps. The first step is low resistance liquidity run. We can split that into two parts where we have low resistance and we have liquidity run. The first thing we need to understand is actually the last part. It's the liquidity run. That liquidity run, the first part of that is liquidity. Liquidity is swing highs, swing lows, so swing points. The run is the run towards it. That makes the liquidity run the target, the drawn liquidity, the bias. So for example, here on crude oil, if we want to continue higher, we can look to target that swing high right there. That is the liquidity, where if we're going towards that high, we are going to potentially run that liquidity. So based on the higher time frame premise right here, we can already look to continue higher. That order block is what we can push higher from towards that swing high right there. Now, once we understand that target, so that liquidity run part, I like to go down a singular time frame to see more detailed price action. And what I mean with more detailed price action is if you go down time frames, it's more candles, more details. Now we need to talk about the most important part of understanding low resistance liquidity run. And that is the first part, the low resistance. Low resistance essentially means there is no resistance anymore. And to understand that, we need to understand what is resistance. If we want to move towards this drawn liquidity right there, towards that swing high, we have resistance going against us where price action is almost trying to stop us from getting there. That creates the resistance part. Resistance defined is unmitigated opposing PD arrays. All right, that's a mouthful, and let's define that, because again, the definition of things makes things simplified, makes things easy to understand, in my opinion, because you just need to know the definition. PD arrays. PD arrays stands for premium and discount arrays. Those premium and discount arrays, like it already says in the name, they offer short-term premium and offer short-term discount. If we offer short-term discount, we can potentially continue higher. If we offer short-term premium, we can potentially continue lower. Now it's important, with the hundreds and thousands of PD arrays out there, we need to understand, all right, but which PD arrays do we actually focus on? Now this is extremely important to understand if you do want to follow along with this video. Because if you do not exactly copy the PD arrays that I use, if you do not mark them correctly, then this is simply said not going to work. The PD arrays that I use and for this specific topic is fair value gap, mitigation block, order block, and breaker block. Those 4 PD arrays can count as resistance, but only if they are opposing and if they are unmitigated. So let's again define that. What is the opposing part? Well, if we are going higher, like we're seeing right there, then in a bullish trend, discount arrays are holding. The opposing PD arrays in a bullish trend where discount arrays are holding are premium arrays. Where in a bearish trend, opposing PD arrays, when premium arrays are actually holding in price in recent price action, we have discount arrays acting as the opposing PD arrays. Now we need to understand the unmitigated part, which is arguably the most important part. Unmitigated means we have not traded back into that PD array yet. But that starts, if we want to see if something is unmitigated, that starts with understanding how we need to mark out that specific PD array. Because if we do not mark out premium and discount arrays correctly, then we might not be getting the accurate story. So for a fair value gap, it's quite straightforward. We just have fair value gaps like that. But it's important to understand a fair value gap can only be traded back into one singular time. The 50%, all nonsense. It's all irrelevant. When we tap into a fair value gap for the first time, we have mitigated that fair value gap right now. Mitigated as in it is now used up. It's not valid anymore. The thing that we can now continue lower off of inside that fair value gap, because what does it leave behind? Previous candle high, swing highs, swing lows. Where here, for example, this fair value gap, as soon with that up candle we trade into it, is now mitigated. The premium array that we continue lower from actually is the previous candle high, not the 50%, not the 75%, is the previous candle high. It's the liquidity right there. And that's a small tip. If you want more accuracy, focus on that. Then the other blocks, so the order block, mitigation block, break block, if you want to mark them correctly, focus on the wicks or the bodies. What does that mean? This breaker right here, that exact low of that wick is overlapping with a fair value gap sitting right there. So the exact low of that wick is overlapping with an exact fair value gap right there, with the body of that fair value gap, essentially. This is when you mark out the wick right there. If that is not the case and the wick is not overlapping, in this example right here, the wick is not overlapping with directly a fair value gap, then here what you want to do is you want to mark out the body instead. Why actually is this? This is because those wicks that we see right there, when we trade below the wick right there already, there has already been offering of fair value to then continue lower. Again, not super relevant, but that's exactly why we do it. Because those wicks on the lower time frame are already retracements a little bit higher to then continue lower. So it's already offered fair value to continue lower instead. Where here, that did not happen because it's just one singular move lower. Now, why is this important again? Because that brings the understanding of which unmitigated opposing PD rays we need to focus on. Again, it's quite a lot, but I promise you it's going to make sense. Stick with me. Let's take that back a little bit. So let's go back in time. Now, this high right there was the target. If we want to continue higher, then here, this move lower right there, we have created premium arrays right there, which can potentially act as resistance if they are, again, unmitigated premium arrays. So let's mark out every single premium array that we have right there, and let's see which ones are already mitigated. Let's use the replay tool for this as well, right there. We have this order block, small little order block sitting right there. We have this fair value gap right there, overlapping with the order block as well. Then we have this breaker block right there. The breaker block has already been traded back into, so it's not relevant anymore. We do not use the body right there. We only use the appropriate selection right there. Otherwise, you're just drawing random lines on the chart. You might as well just trade support and resistance. Then we have this fair value gap. Again, same story, has already been traded back into. Then we have this fair value gap, has not been traded back into. Then we have this order block as well, has not been traded back into right there with the body. And in a small one, sitting right there, we have this fair value gap as well. So if we want to continue higher, at every single one of these premium arrays is where we can expect some kind of rejection. Not necessarily lower prices, but some kind of rejection. Because the higher time frame premise is again bullish. So that aids us in the understanding that they are not there to push price lower significantly. They are just there to sort of annoy us, to just be resistance. So let's see, we have that first fair value gap right there, trade it through, perfect. Then we reach the order block right there, perfectly fine. And we seem to now reach into that fair value gap as well. Both right now have been traded into right there. This is where it gets extremely interesting because this is now the rejection that we are seeing off of that fair value gap. This is the rejection area right there. And that is important to understand because above that rejection area, where we have now this mitigated fair value gap is a no resistance area. Why? Because here we only have swing highs left right there. So to understand, liquidity run, swing highs. Low resistance, mitigated PD arrays. We have no opposing PD arrays again that are unmitigated. Because that fair value gap is now mitigated, then when we only have swing highs right there and we take out this rejection, as soon as we trade above that rejection right there, that's where we can expect price to run quite fast. Why? Because it's a low resistance. There is no PD array that can act as a resistance right there because we only have swing highs, and those swing highs are the liquidity run. They are not very likely to act as a significant resistance. That gray box is again the no resistance area. So what is the objective right here? Get involved before we reach that gray box right there, because when we reach that gray box, the no resistance area, that's where price will run fast. Towards what can it reach for? Well, what is the next unmitigated PD array, opposing PD array That's the fair value gap that we have right there and that small little order block. So it can run fast at least until we reach that high right there, but it can also run fast towards the next unmitigated premium array right there. And the area where we are going to continue higher from is not even that relevant. As long as you make sure once we get closer towards this gray box, the no resistance area, that's where you want to get involved. So here, luckily enough, you have a 4-hour fair value gap right there, which we can potentially push higher from. And the way you get involved right here does not matter. Let's use candle signs, for example, and we enter off of this candle right there, and we cover that low. And we can target the high of that no resistance area. And then even on a lower time frame, we can do the same exact thing, right? This is fractal. I'm doing it on the 4-hour right now to show you the higher time frame premise. But on the 1 minute, this is so extremely effective as well. For example, right there, if we go into the lower time frame, you can see the same exact thing. Now, if I'm looking at higher prices off of this 4-hour value gap right there, I am looking at 4-hour resistance. So I'm not going down a time frame to look at 15-minute resistance off of a 4-hour discount rate that I'm looking at higher prices from. It's quite important to understand 4-hour discount arrays, 4-hour premium arrays that can act as a resistance. Then once we skip price a little bit right there, that's exactly where we have fast price action until we do what? Until we reach that unmitigated premium array right there, the fair value gap and the order block. So let's leave the order block only. Then right here, what do we do again? We create this rejection right there. That is the rejection. The rejection a little bit lower off of what? Off of that premium array, the unmitigated premium array. So if we now take out that high sitting right there, this is the no resistance area. So ideally, we want to get involved before we reach that area, just before we reach that area, because that is where price is the highest probability once we reach that area for it to reach the next high, and it will likely also happen the fastest. So this is also what you can call potentially your silver bullet entry. Now, right here, we continue lower for a little bit right there. We never take out that rejection, and we have quite a big rejection off that order block. Once we continue lower, we create premium arrays going against us again. So what do? We mark out every single premium array right there, the unmitigated ones, which we can potentially see some kind of resistance right there. We have those for value gaps. And as last, we have this order block right there before we can actually reach the no resistance area. Then once you have marked out that resistance, you wait for all the resistance right there to be gone, essentially, to be traded into, to be mitigated now. We have that for value gap right there has now been traded into. The rejection that we saw right there gets traded above. So it gets taken out. We disrespect that. We continue higher instead. Then the last resistance we have is that order block right there, where we now have a few more resistance in the form of this down move right there and a little bit of a higher down move as well right there. Then the next step, once you have marked out all those premium arrays, we have traded into all those resistance areas. Then once we trade above the rejection right there, which is above that high right there, and we only have swing highs left. So all the premium arrays that we had towards the left before we reached that drawn liquidity have now already been traded back into, and everything here is now just swing highs. So this whole area towards that high is now a no resistance area because all we have left is swing highs, which creates the low resistance liquidity run again. So in an ideal world, what do? We want to get involved before we reach this gray area, the no resistance run right there, where every next swing high can be a target. But ultimately, what can be the next target is this swing high right there, because there's nothing else stopping us from reaching that swing high because we don't have any other resistance going against us. Again, the manner on how you get involved in can be your typical trading plan, but it doesn't have to be very accurate, doesn't have to be very precise. As long as you manage to get involved before you reach that gray area, the no resistance area, and your stop loss is in somewhat of a safe place. But price action will most likely happen fast right there. That's the highest probability thing for it to do. So if that does not happen and we are slow right there, that's also perfect because then we don't even want to get involved in the first place. So what I'm saying with that is your stop loss can be quite tight, can be quite small stop loss. For example, again, based on candle signs, this is a perfect entry. exactly what we go over in the current ongoing spring enrollment in the MMT. And then right there, once we continue higher, we see it only takes 3 candles to be precise before we reach that high right there. And after that, we can again expect a little bit bigger of retracement, and we see the fair value area get stepped into before we continue higher again. Now, this is all hindsight. So let's look at some live examples. So GU, we have been continuing lower for a little bit right there. That low is the target in my opinion. And in the move higher, we see certain discount arrays being created right there. We have the higher fair value gap, we have that order block, and we have this old breaker block sitting right there as well. And at every one of those levels, that's why it's so key to mark out the right discount arrays and the right premium arrays, because at those levels right there, we see rejections. Now, right here, before we make the significant move lower right there and we can reach those lows, what do we actually see? We have a rejection area. This right there is the rejection area right there. So below that rejection area of the last discount array that acts as resistance is the no resistance area towards that low sitting right there. That is the high probability price action. That is where price action is quite fast. Now there's a reason why we do not trade back into this fair value gap actually. Now this right here is, like we discussed, I actually discussed that on my Twitter a little bit. That is a sneaky breakaway gap, and we already continue lower right there. Also mentioned in the forecast in the MMT. And then right here, where we are currently at, we can expect quite fast price action to continue lower towards those lows right there. Another example is E-mini S&P right here. Let's study this. We are sweeping this high again. What is the sweeping of that high? We are not offering fair value anymore right there. We create bullish fair value gap, bearish fair value gap, creating a sharp turn sitting right there. What are we potentially looking to target? This low, and the gray box you see right there is also a weekly fair value gap. So that is a very nice drawn liquidity that we actually have. So what discount arrays do we actually have going against us? Well, we had this breaker right there. We don't really see a rejection off of that. Perfect. We have this order block sitting right there. That's where we currently see a rejection. If we want to reach this low right there, then ideally we want to get involved before we reach this gray box, because that right there is where we have the no resistance area. That's where we will most likely see fast price action. And if we do trade into that, it's very high probability that we are indeed going to reach this low right there. So where are we going to continue lower off of? Well, we have this 4-hour fair value gap, but I would argue that might be a sneaky breakaway gap. Little golden tip. How do we confirm if that is actually a sneaky breakaway gap? Well, simple plan of action. Let's just wait for a 1-hour fair value gap lower. If we get the 1-hour fair value gap lower instead right there, we just look to trade off of that instead of the 4-hour fair value gap. Last example right here on US dollar CHF before I give you another golden nugget actually. First things first, what I mentioned a little bit earlier, it is actually not super relevant on what we are going to continue higher off of. If you can understand based on a higher time frame premise which high we are likely going to target next, which can be also very easily seen, all right, well, are we moving higher towards swing highs or are we moving lower towards swing lows? Then once you find that swing low right there, then mark out all the resistance that we have going against us right there. Fair value gap, we have this mitigation block right there where we don't see a rejection, and we have this order block nested inside that mitigation block. Mark the rejection right there that we get off of the last resistance before we only have swing highs left. So we only have liquidity left. That rejection, now flip it around right there, that creates the no resistance area. Ideally, you want to look to get involved just before that. So even the 4-hour right here, 4-hour value gap, confirming that on the lower time frame, getting involved before we reach the no resistance area, that is high probability for it to now reach that high, and that is where it can most likely deliver quite fast as well, if we have also time agreeing with the ID. Now, for your case study, combine this with the understanding on why I actually already expected this third candle of this weekly fair value gap being created right there to be a breakaway gap. So now an extremely advanced understanding, which we have gone over in MMT only thus far, is understanding a breakaway gap before it actually forms due to the no resistance. And to fully understand that, combine this video with the following video, the third candle in fair value gaps. All right, perfect. Thank you.